You get a chunk of cash, do you lump sum invest it, or do you dollar cost average? Chuck it all in straight away, or drip feed it into the market? Like everything with investing, there is a statistically sensible answer, and then there's a more emotional response that we need to consider. Let's take a look, shall we?
I feel so desperately that you're right. Yet to fail.
No one wants to fail.
No, I'm scared.
I can't do it.
And never is the fear of failure more acute than when you have a chunk of cash in your hand and a desire to invest in the stock market. You know that long-term markets tend to be a safe bet.
It's much easier to invest for the long term.
But do you go all in, launching the cash at the market? Or do you spread it thinner than butter over too much bread? If only we could see into the future and know where the stock market was going to end up. It would make this decision of all in or drip feed so much easier. No, it wouldn't. Wouldn't make a blind bit of difference. Doesn't matter if I could sit here and tell you right now that in 10 years the stock market will be exactly here. That's not going to help you make the decision of dollar cost average or lump sum investing. Let me show you why. This is you. And you just got yourself a nice big chunk of cash. You decide you're going to invest with it. Because as well as being given this chunk of cash, the person who gave it to you also told you exactly where the stock market is going to end up in 20 years' time. Think of it kind of like that grey sports almanac in Back to the Future 2.
You'll never lose.
So you and your stack of suspect-looking notes know that in 20 years' time, no matter what you do, the stock market will have gone up 100%. Now, while at first glance this might look like a win-win situation, really it doesn't help you much here. Like in life, it's not about the end destination, it's about the journey. We don't know which route the market's going to take to get us from here to here. It could be a nice straight line up, from point A to point B. In which case getting all your money in as soon as possible is the best thing to do. As buying along the line would just mean you're buying at gradually more expensive amounts, impacting the total value of your pot at the end. But what happens if the market tanks just after you buy? And you take a journey more like this. You missed a chance to buy into the market in chunks at a cheaper rate. You just cost yourself a lot of gains. Or alternatively, you might drip feed and then the market does this. Most of your buying is then done above the price at which you end up. Market's up 100% and you're down overall. Even if we knew the end result, it doesn't help us here because it's not just about where we end up, it's about our journey to that end place as well. And neither of those can be predicted. So the only way to really kind of shed some light on the argument of lump sum investing versus dollar cost averaging is to look at the past. The go-to bit of research on this topic is a study conducted by the legends at Vanguard in 2012. They looked at the American, English and Australian markets and compared the results of if you lump summed in a chunk of cash versus dollar cost averaging at different intervals of 6, 12, 18, 24, 30 and 36 months. Still got the 6 times table down. 12, 18, I got it wrong. 24, 30. With America, they started the analysis in 1926 and then looked at the results for the next decade and then repeated it for every single year after, all the way up to 2011. With the UK market, they did 1976 until 2011 and Australia, 84 to 2011. That is a hell of a lot of data, and I'm just glad that I can sit here and reference these studies rather than compiling all that myself. The study concluded that statistically, lump sum investing was the best. But wait a minute, before you run off and just throw all your money at the market,
Bye-bye.
we need to have a little bit of a discussion about this, because when we examine the data, the mathematical or statistically right thing to do might not actually provide us with that much reassurance. First of all, though, it is worth saying that lump sum investing did come out on top. In each of the 3 markets, the results were basically the same, and it also didn't matter about asset allocation. 100% stocks, 100% bonds, a mix of the two, whatever. The study found across all the different time periods that lump sum investing beat dollar cost averaging about 60% of the time.
They've done studies, 60% of the time it works every time.
It's actually 66%, but that meme's just too perfect not to use. The study also found that the longer the period you dollar cost averaged over, so the more you spread out the drip feed into the market, the more likely you are to underperform lump sum investing. I mean, that makes sense. If lump summing your money into the market tends to win, then a drip feed of 3 months is more of a lump sum than a drip feed of 36 months. The quicker you get your money in the market, the better, statistically. Also, when we're drip feeding into the market, our portfolios are carrying a large chunk of cash. The principles of risk and reward state that an investor that takes higher risks should expect a higher return, unless that risk is buying a JPEG of a tweet. So if you get a chunk of cash and then you decide to drip feed it into the market over a period of time, then your portfolio, by its very nature, is more conservative conservative, and you should expect a lesser return than someone who is 100% in stock straight away because they're taking more risk. But while all of that is statistically correct, the math and data is only one side of the story here. Unlike Paul Rudd's character in Anchorman, Brian Fantana, who would be made up with a 66% success rate, many investors will be sat there thinking, hold on, there's still a 34% chance that this could all go wrong, and the market tanks just after you invest. Also, while lump sum investing has proven itself to be the winner over long periods of time, there have been times in history when the market has looked overvalued.
Wall Street's recent run is poised to give the Dow its best July since 1989.
Well, the economic climate was such that concerns of an imminent decline were understandable.
The COVID-19 economic crisis will be unprecedented and long-lasting.
It reminds me of the stats around shark attacks in America. I think there's a 1 in 5 million chance of being attacked by a shark in America in any given year. But does Keith from landlocked Kansas really have the same chance of being bitten by a shark as a Californian surfer who goes in the water with them every day? Long-term averages fail to take into account short-term market conditions and mask over the point that along the way, in many examples, lump sum investing worked out poorly. The average is just that. It does not describe everyone's journey. These big data sets give little consideration to the individual. Like that stat about sharks fails to take into consideration that if you swim with sharks every day, you've probably got a higher chance of being bitten by a shark. It's also worth considering that while lump summing is a clear winner, the end result in terms of performance isn't vastly different in most of the modelled examples. In the United States, a 12-month dollar cost average led to an average ending portfolio value of $2,395,824. While lump sum investing led to an average ending value of $2,450,264, or 2.3% more. So you could probably take some reassurances in the fact that if you took the high or the low road, you'd have ended up in a similar spot. But don't forget, this is averages over a massive data set. The study itself says there are fairly wide distributions of outcomes. It's possible for either strategy to underperform the other over a given period, potentially by a significant amount. So anything can happen and we don't know what's going to happen. So what can an investor do? For me personally, I think that this is more of a question of how you're going to react than it is what's the sensible thing to do. So what makes you lose more sleep at night? The idea of missing out on some gains, or the idea of investing in the market and then seeing it collapse straight after you've just done that? Many people watching this would likely be kicking themselves if the latter was the case. Loss aversion is the human tendency to prefer avoiding losses over getting a win. Losing £1,000 feels worse than winning £1,000 feels good. And it's this loss aversion that we need to factor in when making our decision. Vanguard actually comment on this within the study. If the investor is concerned with reducing short-term downside risk and the potential for regret, then dollar cost averaging may be a better alternative. It all comes down to this. Markets tend to trend upwards over time. So if you've got a long time horizon for investing, then it makes sense to get as much money into the markets as quickly as possible. But if your time horizon is shorter, or you're the type of person who wants to minimize the emotional impact of loss aversion, then dollar cost averaging your pot of cash might be the way to go. I just want to clarify before we end as well that dollar cost averaging in this sense refers to having a chunk of cash and either putting it in the market straight away or spreading it out, not the monthly consistent investing that most people do. Because if you think about it, dollar cost averaging on a monthly basis is actually lump sum investing because you're putting the money in the market as soon as you got it. If it was my choice and I had a big stack of cash that hit me now, I would just launch that all in the market straight away, no bother.